Okay, so we have explained the idea that we could think about business models as systems. And this is exceptionally important when you want to build a high impact, high growth business that can become significant on a global scale. And we looked now a little bit on how these systems of effects and conditions can interact between our company, our business model, and things in the environment. We can take some time to think about some obstacles, some frictions that might occur, and that could be related to things like a competitor. You can map this if you like. And there's a really good article on making successful business models from Harvard Business Review. It's from Casadesus, Massanel, and Ricard, 2011. Anyway, so we have Boeing. Boeing had a 747, and the 747 was the only plane in that category, so they could charge premium price for it. And they put that profit that they made into R&D and improved the plane. So this is choices that we have, and this is effects. And the market effect was that it was more interesting, higher value, because we improved it, using some of our margin to improve our product. That's how you do when you want a sustainable competitive advantage with the old Porter model. You get the premium price, high margin, some of the margin you invest in product differentiation, so you keep your advantage. Otherwise, others will copy and catch up. Or you have the low cost, but not necessarily low price. You have as high price as you can. So the low cost gives a margin that is greater than other low cost competitors. You take some of that margin, invest in better effectiveness and efficiency in your production, and trying to squeeze out a bit more of your resources. In this case, it's the differentiation strategy. And costs are down because we have higher volumes, and the profit is, again, we're back here. It feeds into each other in each step. Also, what was troublesome for the competitor, Airbus, was that not only did Boeing earn a lot on the 747, they used some of that to lower the prices on the other ranges of smaller planes. So they couldn't charge full price for their planes. They got their margin squeezed by the competitor being able to lower prices because they couldn't get back on the segment where they were alone. Very, very difficult situation. It's difficult to R&D or develop yourself out of it because you all the time have less resources. So in this nice circle, there are some things to consider. First of all, if you have this money-making machine, there is a threat that people come in and imitate, of course. There is a substitution threat, which is somebody tries to make something slightly different to get your business, and a hold-up threat and so on, that you run into a wall that something cannot be improved further. Maybe there is not so many more planes that be sold, even if you lower prices. Maybe there is a R&D restrictions. You cannot make planes infinitely big. They will be physical restrictions. Then we have interaction. So this was the problem for Airbus. They got lower market share. The volume was smaller, so the cost per plane was, they couldn't really compete here. And the profit declined, and then they had less to put on R&D. And even more trouble next run in the cycle to keep the price up. And what they did is that they actually borrowed a lot of money from the French government and built the Airbus 380, this huge two-level plane, two-story plane. That was the only way out. They also had to be in that segment. Okay, so we can see that if you have two companies or two clusters or two ecosystems, they compete with each other. And there might be interaction points here that we want to consider when we set up a systemic business model. Of course, we want to have interactions with the environment, setting everything up in our favor. That's how we get that growth coming. But there are some things that could be potential frictions or blockers, and that can relate to different actors, especially competitors, but also some others. So we can have a broad sense of what kind of actors that we have interaction points with. But something that could be a problem is that technical standards are blocking it. That could be anything from a physical format on connectors or operating systems or something like that, to how things are organized and put into agreements. We can have complementary dependencies. We want to start building electric airplanes, but that requires a complementary innovation of charging or battery swapping. And then the actor, that is the airport, needs to also adapt to that. So these two first ones actually connect to what we talked about co-innovation risks in the ecosystem. Something else is needed for us or for our customers to enjoy the full value of our solution. There are also other pieces that needs to be in place. And it also connects to the adoption chain risk, that has to be a plus for everybody that is involved in bringing it to the customer. Other interaction mechanism, well, in the end, the market size, earlier on it might be fine that all companies grow. In early markets, that's the case. There's a huge growth, but you can grow by adding more customers to your business without taking it from the competitors. But when the potential is starting to get exhausted and a lot of the customers have adopted your innovation, a connection comes into play, because what you do will be depending on what the others do in a much higher degree. And then we also have these 5 forces that might pose different constraints or interaction points between the business models' effect systems.